joining again to Thompson Hine's Coffee Chat series. My name is Cassandra Borchers, and I'm a partner in Thompson Hine's Investment Management Practice Group. With me today is Brian Gage. He's a colleague in our Employee Benefits Group, and Brian is my go-to. He's the person I always consult with when we are performing due diligence or negotiating a side letter for an ERISA investor. He's a wealth of information. So Brian, thank you very much for joining me today.
Thank you, Cassandra.
So today we will address the ERISA litigation landscape for investment advisors and fund managers, application of the DOL's new guidance regarding cybersecurity to protect participant data and plan assets, permissible consideration of environmental, social, and governance, in other words, ESG factors in making investment decisions, and when advice to participants makes an advisor a fiduciary under ERISA. All some pretty weighty topics. So to kick it off, Brian, why don't we get into the ERISA litigation landscape, and if you could talk about how that has been impacting employee benefit plan investments.
Yes, and so we actually have very distinct and drastically different depending on whether the pension assets are defined benefit plan assets or defined contribution plan assets. For defined benefit plans, that's where you have a benefit formula that defines what the participants are going to receive. So the risk of investment loss is on the plan sponsor. In that situation, the Supreme Court in 2020 stated that plan participants do not have constitutional standing to challenge investment decisions. So this means that participants will get their promised benefit regardless of an investment decision, so they don't have any right to challenge what the fiduciaries are doing. And so that's actually great news. On that landscape, it makes it very easy for plan investment committees to negotiate agreements with investment advisors because the advisors are more willing to give better indemnification and a higher standard of care because there really is very little risk. I mean, the risk is that the Department of Labor could sue, but I think it has other things on their mind. It's also possible that one plan fiduciary could sue another, but it's very low risk. And because of that, it's very easy to negotiate agreement. The defined contribution side is exactly the polar opposite. The problem in the defined contribution side is that participants do have standing and they sue. There's actually been an exponential increase in the amount of ERISA litigation dealing with 401k and other defined contribution plans. And primarily it's because these cases are settling for millions of dollars and the plaintiff's bar is getting millions of dollars in attorney's fees. And it's a growing area or niche practice for plaintiff's attorneys. And primarily that's because it affects the bottom line, to participants. So if participants have a bad investment result or if the fees are too high, it's easy to file these lawsuits and to basically, as a result, the investment committees and others have to settle these. One aspect of this litigation is usually they say, oh, there were other, lower priced, better funds, better performing funds, conflict of interest are thrown in. And what this really has done as far as investment advisors, as far as negotiating investment management agreements and investment advisor agreement, is that it's much more negotiating because there's something really at stake on indemnifications and the standards of care. And investment advisors actually have to start worrying now too. I've seen recently a case where an investment advisor was added to the allegations asserting they had a conflict of interest in their advice they were giving to the plan. And so there's a lot more risk. And so there's a lot more negotiation. And what it's also doing is that I think it's altering the market a little bit. There's a lot more movement from custom design target date funds more into collective investment trust. People are moving away from the active funds to the low cost passive index funds because a lot of these cases, focus on the fees. And so very drastic different environment than the defined benefit.
That's interesting. So maybe you could walk us through what is a collective investment trust for anyone who isn't aware of those.
Yeah, in one sense, they're a lot like a mutual fund, where in mutual fund you usually have participants investing, or you can have plans. But really, collective investment trusts are usually managed by banks, and they basically have qualified plans. You know, you need to be a qualified plan to invest. And historically, collective and trust usually were like lower or smaller size plans invested in those. But now we're seeing more of a trend that their fees are coming down, and they're also now a little bit more willing to negotiate side letter agreements. So you're getting much higher level of plan sponsors and plan fiduciaries, instead of designing their own custom design funds where they get a variety of investment managers together to do a large cap fund. They'll just go into a collective investment trust instead.
Yeah, it seems like I've seen more of those recently. So, in terms of this litigation, is there any hope in sight regarding the defined contribution litigation? Is it really all about the results, or is it more about the process? What do you see on the horizon, and is there anything out there that could be helpful?
Well, yes. I mean, one of the key things that is, and everybody's anxiously waiting, is that the Supreme Court heard oral arguments in December regarding a Northwestern University case. And in this case, the hope is that the Supreme Court will set a tougher pleading standard. And what's important in litigation is you have three stages. The first stage is the pleading standard, where somebody pleads something, and usually you'll file a motion to try to dismiss at that stage, and that's very inexpensive for the fiduciaries to get out of the lawsuit. The second stage is the summary judgment stage, is after the pleading. If they survive the pleading stage, then they can do discovery, which is more expensive. And at the end of that, you can go and have a summary judgment motion, and you might be able to have the case dismissed at that stage. If you don't win at that stage, you're going to trial, which again is just so much more exponentially more expensive. And so the hope is that the Supreme Court will come up with a tougher standard at the pleading stage. And really, one way to phrase the question is that ERISA generally is about process. If you have good process, the court should not be second guessing your result. But what the plaintiff's bar has done in a lot of courts, and it's mixed, depending, a lot depends on the judge or court that you get, is that the plaintiffs assert that, look at this fund's fees compared to this fund's fees, that performance is so bad, you have to have an inference of poor process. Or this fund performed so horribly, anybody would have known that these fiduciaries had to do something wrong to have chosen that fund. And if they're allowed and can get through the pleading stage, and then they can go and start doing a lot of discovery, and maybe find things that will help them along the way, or the plan sponsor fiduciaries will settle the case so that they don't have to pay it. And there are lots and lots of cases to settle for millions of dollars. And so that's the key part. And the hope is that the Supreme Court has set a tough pleading standard, so a lot of these cases can settle, and that this exponential growth will slow down.
Okay, fantastic. I should also mention we do have a Q&A function, so if anyone has a question, you can go ahead and submit that while we're talking, and we'll try to get to it in real time. So a lot of the things that you and I work on are actually private equity investments for ERISA investors. And so how is all of this litigation impacting those private equity investments?
Yeah, for the most part, on the defined benefit side, obviously there's not much lawsuits, but you still have a fair amount of private equity. Really, what's impacting the private equity is that there's a shrinking asset pool. Defined benefit plans, a lot of sponsors are annuitizing portions of the plan, i.e. going out to an insurance company and offloading the liabilities and paying the insurance company to take the liabilities for maybe retirees or certain groups. And that's shrinking the asset pool. And as the asset pool shrinks, that usually means there's going to be less money to invest in the private equity. And so even though the risk is very low, it's just less on the defined benefit side. As far as the pool of assets available. On the defined contribution side, it's pretty rare. You usually need the very largest, most sophisticated investors were the ones who had maybe a target date fund with a private equity component in it. And, during the prior administration, there was a little boost or a nudge in saying, putting a little warm water on the private equity and defined contribution plans. There was an information letter came out and said, yeah, there's a lot of issues you have to work through, but yeah, you can have private equity and a defined contribution component of, say, a custom designed fund. The most recent administration, this past December 2021, said, no, don't overread that. We're not recommending this or encouraging private equity and defined contribution plans. It's really that letter is limited to defined benefit plan or sponsors with defined benefit plans who may want to dovetail with the defined contribution, and don't read it too broadly. And so they basically poured the cold water on it. The one aspect is important is that ERISA doesn't specify these are the only investments you can do. So in theory, you can invest in anything under the ERISA statute as long as it's prudent. And a recent case involving Intel, in which they did have a non-traditional investment in their fund lineup, in the sense making up like a target date fund or certain global equity funds, et cetera, is that the court ruled in favor of and dismissed some of these claims against Intel, that basically the plaintiffs couldn't just allege that, hey, this is unusual and past that pleading stage, that they had to show more. They had to get a benchmark and say, well, why wasn't this fund not meeting its benchmarks, et cetera. So the private equity funds, there's still some, if you have some traditional defined benefit plans, there are, fortunately, we do work on some of those together that still have, investments in that area. It's great because low litigation risk, but shrinking pool.
Yeah. Okay, great. Well, let's switch gears a little bit. Recently, the DOL put out cybersecurity guidance, and I'd like you to talk a little bit about how that guidance applies to investment managers and private funds.
Yes. So the guidance was in form of best practices. So these aren't regulations, so it's not mandated. However, best practice soon become industry standard, and fiduciaries are supposed to be prudent experts and kind of make sure they're meeting the industry standard. So basically, our approach is that basically this is the law. I mean, this is what you really need to be thinking about. And there were three parts to the guidance. One dealt with best practices for plan participants. And usually what we've been doing with that with plan sponsors is saying, hey, add this to your summary plan description, put it at the end. We also, a lot of them have done or considering whether or not to do their own like communication program to help plan participants learn more about best practices on cybersecurity. The second component of it is that the Department of Labor had best practices regarding contractual provisions with service providers. And for the most part, the guidance was geared toward record keepers, the ones, if your 401k plan, your record keeper has all your personal data, your social security number, they have your 401k account. There were
private information.
There were court cases in which people are calling up fraudulently and trying to get people's 401k monies. But the guidance said participant data and plan assets need to be protected. So our rule of thumb is that anybody who needs to have an ERISA bond because they could steal money actually needs to be very aware of cybersecurity, and we need cybersecurity language in their agreements because if they can access the money and get the plan assets, then some cybersecurity criminal can also. So we're seeing that. We're going with investment managers. They'll see it. If they haven't seen it already from some of their clients, they will, is that, they'll go out and say, we need cybersecurity language now in our contracts. The third component of it is just protocols on, what is a good cybersecurity practice. And that's kind of an IT question. But again, it touches on your investment managers in that, and also touches on the company itself, because the plan sponsor is a service provider to its own plan, is that you go through the IT department goes through the Department of Labor best practices and compares it with what they currently do. And for a lot of clients, this is pretty easy. They do government contracts, and the government always is requiring them to prove their cybersecurity. But it's just sort of another one of these. For other industries, this might be brand new. They may not have quite the same level of sophistication on their IT side. The DOLs isn't a high standard. I mean, I've heard from a lot of clients, oh yeah, we do all of this already. We also hear that, yeah, there's a lot even beyond this, but it's kind of a good baseline, but it's need to. And so there will be some clients we have who will be reaching out to their investment managers to ask them about their cybersecurity practices.
Right. And any registered investment advisor is used to that, but it's just one more side of it.
And you mentioned, yeah, I should say you also mentioned not only the managers, but on the private equity side.
Mm-hmm.
And so even when a private equity fund doesn't have plan assets, we actually are also just asking it in those side letter agreements with private equity funds, just because we think it's good practice. I mean, they really should, because people are stealing money and through cybersecurity and plan, investment managers and private equity have the money.
Right. And we've been successful in getting that in side letters without too much pushback. So on that note, maybe we should talk about when a private equity fund would hold plan assets, what the limitations are and some of the exceptions.
Yeah, so a general rule is when a employee benefit plan invests, say, in a public company or in a mutual fund, a registered fund, basically the investment itself, the General Motors stock or the whatever mutual fund it is, that is the plan asset, not the underlying asset. But there are situations where if you invest in like a private equity fund, at times the underlying assets could be considered plan assets. And that is incredibly important, because if the private equity fund holds plan assets, that means the manager of the private equity fund is going to be a fiduciary. It has to satisfy the ERISA bonding requirement. It has to satisfy all of the ERISA requirements, including conflict of interest issues, prohibited transactions. And so it's very important to be on one side of it or another. You're either going to be subject to the, have plan assets, to be subject to ERISA rules or not. And the key dividing is they say, well, if more than 25% in general employee benefit plan monies are in the fund, it's going to be subject to the ERISA plan asset rules, unless one or a couple other exceptions apply if you have a real estate operating company or a venture company operating company. But you'll see, and we know that most of the time the line is that in the private equity funds, they kind of try very much to keep it under 25%, or they'll give their best efforts. We're aiming to keep it under 25%. We're going to use our best efforts to do that so that we're not subject to plan asset. But not all do that. I mean, but there are risks that if you do have plan assets, or there's concerns, I would say, is that people do it, but a lot of times the larger plan sponsors and plan fiduciaries don't prefer not to have private equity that's actually ERISA fiduciary status.
And that also informs a lot of side letter provisions, I think you and I have noticed with some of the ones we've done, there's not always a lot of clarity around whether or not they are a plan fiduciary. We like to get that clarity in the side letter.
Yeah, and also if they do trigger it, sometimes you want to try to get rights to be able to withdraw your investment.
Right.
You don't have that right under the private equity funds, but you usually try to seek that right. You also try to seek, if it's plan assets, again, you try to seek to make sure that any distributions out, or actually in general, any in-kind distributions, you have those things. So yeah, you definitely want that. You also want them to rep that they're going to be a fiduciary and have qualified professional asset manager status, just so if they ever did trip over the line, they won't be creating prohibited transactions to sort of add to it. But the withdrawal rights is a good one to try to seek. And again, depending on the size of the private equity fund, quite often we're very successful on that.
Right. Okay, next topic we have to talk about is ESG. There's been a lot of activity in this space, once again, from all different angles. But let's talk about it with respect to ERISA and what's going on in that space.
Yes. Now, in the ERISA space, ESG has been around for a long time. Actually, the Bush and Clinton administrations all the way through have all come out, going one side and then the other on the ESG issue. But as a background, the fundamental starting point, and there's like three tiers of analysis on this, is that, the Supreme Court came down with a case and said what you need to look at when you're wearing your fiduciary hat is the pecuniary financial interests that are participants in the retirement income. Everything else is not, you're not supposed to look at. You're supposed to look solely at that. And so that's kind of the first layer. You always want to make sure it's financial, or sometimes the new guidance calls it risk return factors. And a lot of the debate then, or one view of it is that the Republican administrations are very skeptical that ESG factors are actually economic, that they really have nothing to do with economics, that they're really social policies that you're trying to give these investment funds or the red light to go and use their monies to follow on certain social causes that they're interested in. Whereas the Democratic administration say, oh, you have to be, and actually somebody at the DOL said this, you have to be willfully blind to not think environmental is not an economic factor. I mean, that's the spectrum that we live with, and it goes back and forth where each administration says, oh no, you really have to prove that something is ESG is economic, and then the other side, of course these are economic. And the third layer of it, I just kind of big picture is that I think a lot of why it's such going back and forth is if you designate something as economic, one of these things is saying, if you don't do this, we're going to be able to withdraw millions and billions of dollars of money from your funds or your stock. It does create an economic, and that's why it's kind of been important from a political standpoint. But as far as plan sponsors are concerned and investment advisors, really the best thing to do is to focus on, is it pecuniary? If you're right now, a lot of sponsors haven't jumped into it for 401k plans because it's so hard to define what's really ESG. You see a lot in the market now, everybody puts ESG in their fund title, but they're no different than what they were as an active manager a month before. And so, because
there's no defined standards.
and,
right.
And so what is ESG? But there is a notion that if you're a sponsor, I mean, really, it's not the sponsor's decision, it's the investment committee's decision. You want to kick the tires. You want to look and see exactly why do they think this has an economic pecuniary? Why is this good for the participants? If you can go out there and document why you think this ESG fund is going to be better than other funds, or do just as well as other funds, and you document that, and you say, hey, this is why it's pecuniary, this is why it's great, you're gonna satisfy the standard regardless if it's a Republican or Democratic administration. So we recommend that. And same thing as if you're an advisor and you're looking into this market is, can you come up with something that makes it look pecuniary? Again, I think the more pecuniary financial base that you say, hey, this is going to produce better results, the better you're going to be to market it to 401k plan. Less risk, on the defined benefit side, participants don't sue. It's really the plan sponsors, because they fund the plans that really have the risk. And so, a little bit different dynamics on the defined benefit side, but on the defined contribution side, the key there is to make sure you have, good documentation.
Right. Do your due diligence and have that at hand.
Yeah.
Okay, so on another note then, I think there's been some additional guidance or perhaps a change recently. So when an advisor or sponsor gives advice to a plan participant, is that subject to ERISA?
Yes, and so there was what they call the 5-part test to determine when somebody gives fiduciary or gives advice to a participant, whether or not they would be considered to be a fiduciary. And that was actually established way back in the beginning of ERISA, long ago in the 70s. And then during the Obama administration, they got rid of the 5-part test and came out with a new test. And the Fifth Circuit overruled that new test and said, no, that you went beyond your authority to issue that guidance. And so the 5-part test got reinstated. But what's important is that the 5-part test, even though it got reinstated, it got reinterpreted. Actually, it got reinterpreted by the Trump administration. And so they said a couple of things, is that historically giving advice to a participant to do a distribution so that they could roll over the money into an IRA, they said, oh, that wasn't giving investment advice, but now they say that is that, hey, that's the biggest investment advice, whether to invest in the plan or not, and to have the money rolled over to an IRA. So that prong of the 5-part test, they flipped it and said, oh yeah, that can be investment advice. Second, there was a requirement in the 5-part test that it was regular, ongoing relationship. And they basically reinterpreted that and said, well, the first time you talk to somebody, if the anticipation or expectation is that's going to be ongoing, well, that's enough. That you could be a fiduciary on the first call. And so you don't have to say, hey, I was cold calling somebody saying, hey, roll over to my IRA. I'll do some great investing for you. Well, you in the past had that leg of the 5-part test. You said, hey, this is my first call. I don't have to worry. But now you do, because it's long term, and also the investing could be in the IRA. It doesn't have to be in the 401k plan. The last part was mutual agreement. It had to be like a mutual understanding. You're giving individualized advice on their circumstances. And sometimes you have disclaimers. Oh, we're not a fiduciary. You just disclaim and say, oh yeah, hey, we have a great product. I can make a ton of money for you, Cassandra, if you just roll over this money to the IRA and I'll invest it for you. Oh, by the way, I'm not a fiduciary. And that's not enough. Their guidance is they'll look through that and look at the actual realm of it. And so what this means is that more people are going to be fiduciaries. And the flip side of that is, because more people are fiduciaries, you have more situations where now if I call you up and I'm a fiduciary, I say, hey, roll over to my, to an IRA, I'll invest it for you. Well, I have a conflict of interest. I'm going to make money if you roll it over to the IRA, where previously it was in the 401k plan. I wouldn't necessarily. And so in those situations where I have a conflict of interest, where my advice is going to benefit me, the advisor, financially, there's a new prohibited transaction exemption out there that has a lot of detailed requirement. And what we're seeing is couple-fold. For your big record keepers, plan sponsors need to go out to the record keepers and find out what their plan is regarding this fiduciary status. And for investment advisors, what we're seeing is that those advisors are really going to take the position that it's too much work to comply with the exemption. We're going to try to fit into not being fiduciaries. And the best way to do that is to say, I can't advise you. Call your record keeper or somebody else to get advice, get independent advice, document it, say your why, say you have conflicts and everything else. The downside of that is they may go through that process and talk to somebody and leave the money in the plan, but really that's the only thing you can do to protect yourself if you don't want to go through all the procedural hoops of the exemption.
Okay, great. Well, I think we've got about 1 more minute. If anyone does have any questions, you can put them in the chat or the Q&A section, and we can answer those. I'm not seeing any. So, Brian, I want to really thank you for your time. I think that's going to conclude today's chat. And if you've missed a past coffee chat, we encourage you to look at our library of recordings, which are available on Thompson Hine's YouTube channel. We want to thank everyone for attending today's program. I hope you found it useful, and we extend, once again, a special thank you to Brian for sharing your insight. When the webinar ends, you will each be prompted to take a survey and provide feedback. Thank you again, and enjoy the rest of your day. Till next time.